done all the hard work to find your first HMO property deal. How are you going to fund it? Do you have savings that you can use from your day job, or do you need to find other people's money? The reality is that you only have 3 options for funding, and in this episode of the HMO Experience, we'll dive into all 3. I'm Matt Harris and welcome to the HMO Experience. Whether you're looking for a profitable side hustle or launching your next business venture, this series is all about helping you get started with your own rental arbitrage or rent-to-rent business. I'm sharing what I learned from starting and scaling my own business in London, mentoring mastermind clients, and hosting the HMO Experience Property Podcast. By following this series, you'll also get access to a bunch of free resources to help get your business off the ground, including guides, checklists, and templates. So make sure you hit that subscribe button so that you get notified when new episodes drop. It's all well and good building the knowledge and finding your first property, but how do you finance that deal once you've done all the hard work? You have 3 options. You can use your own cash, which is probably the most effective way as you don't have to give up anything or pay any interest. You can look at different funding options, including crowdfunding or bank and bridging financing in return for security, and you can use other people's money. This video will break down all 3 options and provide you with guidance on some of the benefits and pitfalls of each option. You can also download the free Ultimate Guide to Funding Your HMO Property, which clarifies these options by clicking the link in the video description below. You ready? Let's jump in. Just to kick us all off, Jamie, would you mind just giving us a little bit more of an overview, I guess, of the options that are available?
Yeah, sounds good. So again, there are 3 key areas of finance. One is cash, your own cash. It's the cheapest possible source of finance, of course. It doesn't cost you anything. You've got access to it quickly. If you've got access to go and buy or fund your rental HMOs, perfect. The second way, of course, is some sort of bank or traditional lending, and we'll cover that in a minute. So it's banks, bridging loans, crowdfunding, for example. And then the third option is using, as Matt said, other people's money. And we'll talk about some of the key things you can and what you can't do, and who you can borrow money from or invest with your HMO properties. So yeah, those are really the 3 key areas.
I think if we start with the first point you mentioned, your own cash. Undoubtedly, people out there who may have been saving for a while, or they've refinanced property, or they've crystallized some investments that they've got, so they have cash which is available right now. When you guys started, did you jump straight in with working with prospective investors, or did you start and buy your first couple of properties with your own money, Jamie?
So buying properties, I bought one with my own cash, and I'll come on to who that was with and how I did that shortly. But then I've used every single, we bought, I think it's 37 now, maybe 38 properties. We've bought all apart from that first one with other people's money, so we'll come to that. Now, rent to HMO is different. As you know, Steve and I set up our rent to HMO business. It doesn't need much money to get started, and so we used our own cash. In fact, it was an interest-free credit card, but a personal credit card, and we used that to help finance the first property. And we made sure, obviously, with the profit from that first property, we paid back that debt. Even though interest-free, we paid it back. So again, it was then self-financing after that. So in effect, our rent to HMOs was set up with our own cash, and then our first property I bought with my own cash, and then I used other people's money to buy all the. One of the properties that we bought not so long ago for an investor up in Coventry was these 2 guys worked together. They were business partners, and they both put some cash in, and they bought a house for cash, and they refinanced the refurb and paid the sourcing fee in cash. So if you've got it, of course, it means that your cost of finance is 0, so you're not borrowing it from anybody else. And that could make a massive difference. The downside, of course, is tying up your cash. If you want to basically invest in it, leave it in there and get the rental income from the HMO, that's cool. But if your strategy is to use your own cash to buy and then redevelop the property and then pull money out, then again, depending on how much you put out, depends on a whole bunch of factors, including what you do to the property, what the end value is, of course, and then how you're running it. But we can cover that in another episode. But yeah, cash is amazing. If you've got your own cash, it's amazing. It's cheap. It gives you speed. It gives certainty to people you're buying from that you're good to go, and therefore you're much more likely to complete on that deal. So lots of benefits.
So I guess let's go on to the next point, which is the more traditional finance option, which is bank finance, mortgage finance. What is your experience in that?
So that's cool. Before I did HMOs, so back in 2010, 2011, I bought a bunch of single lets. I've used my own cash for 1 or 2 of those by refinancing my house to put out some of the equity. And they were very small, 2 up, 2 down properties up in Leeds, and the purchase price was low. So I could buy a few of those, but of course I ran out of cash in no time at all. So I have used my own cash for some property purchases, but like most people, normal people, unless you're as rich as Midas, you're going to run out of cash. So then you've got to go to other forms of finance. So the more traditional route is what most people do, whether they're buying their own home, of course, or a single let, or a commercial building, or an HMO. So there's, again, three areas we can talk about here. One is traditional lenders like banks or building societies. The second is crowdfunding platforms, which I haven't personally used, but I know lots of people that we train and teach and mentor have used crowdfunding to finance their rent to HMO businesses, but also looking to buy. I'll come on to that in a minute. Yeah. And the third area is a bridging loan, short-term lending, and I've used those as well for buying single lets, but also for most of the HMOs I've bought, and I'll cover those too, shall I know?
I'm really interested actually about crowdfunding. I know that it's been around for a little while. I think there's a couple of specific property crowdfunding sites. Yeah. So what's their feedback been about crowdfunding?
Again, just be very clear that you know what you're getting into and how the funding works. We'll go on to the crowdfunding right now. So crowdfunding, there's two main types. One is in effect a loan. So you are asking a group of people in a crowd using an online portal, and there are loads of them, as Matt said. Some of them that just spring to mind are the likes of Simple Crowdfunding, Simple Equity. We've got Property Crowd, Shojin Property Partners. There's a whole load of them. So go and check those out on Google. But the key thing is, on many, if not all of those platforms or providers, you've got two key things. You can do a loan, and the platforms are great at bringing together a pool or crowd of people who each put in a bit of cash. They pool their resources and they use that cash to either loan to potential people like us who are looking to buy a house, or indeed set up a rent to HMO business, or they're doing equity. So they're taking an equity stake in the property and sharing some of the uplift in the value and potentially the rental income from that too. Those are the two key ways. It's very straightforward. One of the beauties of using crowdfunding platforms is that the crowdfunding providers themselves, the platforms, they often do the due diligence to work out the type of people who are on there, and they also do the due diligence with people who are listing their properties to buy, who are looking for investment, or indeed their businesses if you're doing rent to HMO, for example. So they're doing some of the due diligence for you. So if you're looking to borrow money, they will expect, of course, to look into you, your business, your property opportunity, before they will ever, of course, release that to their crowd of people who are on that platform. So that's a good thing if you're looking to raise money that way, because they do lots of work for you. Yeah. One thing I would strongly recommend, though, is that not every crowdfunding platform is FCA or Financial Conduct Authority regulated. So if you're looking to borrow money, you are liable to pay that money back, of course, whether you're looking to do the loan route or indeed the equity route. But for someone who's looking to invest their cash, I would strongly recommend to make it really transparent, really above board, and to protect everybody involved. You go to a company, a crowdfunding platform that's FCA regulated. There are all sorts of protections. We won't go into that now, but there's also all sorts of protections for everyone involved who uses platforms like that. And there are quite a few of them. So I'd definitely do that.
Okay, so let's look at the more traditional sort of finance option, which is getting mortgages sorted out, whether it's bridging loans or your traditional buy-to-let or HMO mortgage.
So Matt and I are in no way, shape or form giving advice, financial advice. We're not experts in finance. We've literally just raised it ourselves and asked our power team for expert advice. So I strongly recommend you get a broker. If you're looking to raise finance, whether that be bridging finance or any form of finance like traditional mortgages, use a broker. And here's why. A decent broker is someone who can understand you and what your requirement is from a lending point of view. And they can then package you up almost and go out to the marketplace to find a suitable lender or lenders that would want to work with you. So it is invaluable to have someone who knows their stuff, because there are so many lending opportunities or products out in the market. The last time I heard this was something like 3,000 lending providers and individual products you could go to, some of which you'd be eligible for and some of which you won't. But why spend your time and effort wasted trying to find it out yourself when you could go to a decent broker who can not only understand you and what you're looking for, but also do the legwork with you to find you the best opportunity?
No, so you mentioned obviously rates and for the products that are available, and pay fees and that type of thing. Can you give us a little bit of an example of the sort of rates that are available available, an indication as to arrangement fees and that
Sure.
type of thing?
Yeah, cool. So again, one thing I can guarantee, Matt, is that when this is published, this episode,
Yeah.
what I'm saying now, I guarantee will be up to date by the time you're listening to it. So that's the first thing. So use somebody like Mark who can help you out. Some of the lenders that I've been personally using with some of their products, like Shawbrook Bank, and I'll come on to this in a minute, have taken temporarily, I believe, but I might be wrong here, but I believe temporarily they've taken some of their HMO lending products out of the marketplace. They're still there, they're still lending, but the product I've been using for the majority of all of our purchases has currently temporarily been replaced. By the time you're listening to this, it might be back on the market, but at the moment it isn't. Yeah. So that's why you need someone who's up to speed. Yeah. So the market's changing. Some have changed their rates that they charge. Some haven't changed them at all. Some have changed rather the loan to value they're happy to lend to you, and some haven't. So again, it's a movable feast. There are HMO lenders out there who are looking for people to buy or lend their money to go and buy HMOs. You will get a mortgage. It's typically from a minimum of £50,000 up to about 10 million, depending on the project and your experience. They will typically lend a maximum of 75% of the loan to value, i.e., let's just say a property is worth £100,000. Yeah. The maximum they will lend you in the current market is 75% of that, i.e., £75,000. So you will have to make up the shortfall with regards to the deposit, which is typically 25%. The period of time they can look to lend is, again, typically 25 years. Yeah. Some are shorter, some are longer. Some are happy to offer fixed rates, variable rates, or tracker rates. So the amount you pay back can either move as the interest rates in the UK change, according to the Bank of England, or they can be fixed in stone, or they can be a combination of those two. And also the rates they charge, the actual interest rates. Now, when Steve and I and others we work for are looking to buy, we always try and look at the worst case scenario. So the long-term average of the cost of money, i.e. the amount of money you've got to pay back, is 6%, okay? Now, at the moment, you can borrow money way less than that, but the long-term average is 6. Check out, by going to a broker, the type of rates that you are available to get when you're looking to buy.
Other than economic circumstances, what things sort of impact the level of rate that you get? Does experience sort of weigh in there quite a bit? Does the amount of money that you're able to put into the deal have an impact on that sort of stuff as well?
Yeah, definitely. Again, every lender is different. This is where a broker can help package you up as a potential client to a lender. So some lenders want to know what your experience is. Some lenders will not give you an HMO mortgage if you haven't got a single, buy-to-let property, let alone an HMO property yet. But others will be happy. Some will be happy to lend you if you've got zero experience, but the rate they charge or the loan to value might reflect that. And as you have a bit more experience and track record, they might reduce the rate and also increase the loan to value. So it's all about risk from a lender's point of view. Those are some of the things that bear in mind. If you are also using a provider, maybe a build team to refurbish the property for you, and you're looking to commercially revalue that to pull money out at the end, if that build team has got a whole bunch of track record and experience of doing that, that might also either help with the lending rate or be reflected in the lending rate from that lender or not. So again, this is where your broker is really key. So the decisions are often made not on necessarily you as a person, it's on the property you're looking to borrow the money for and what you're looking to do with that property, but it can also be influenced by you as a person and the team you've got around you to do any refurbishment works.
So we've covered the types of interest that will be charged and obviously the term of the mortgage. Is it common for sort of HMO mortgages for you to have interest only, or is it always going to be capital and interest repayment, or do you get a choice?
You do get a choice depending on which lender you go to, and also depending on your level of experience and what you can do to the house. So there will be lenders that don't do interest only, and there will be lenders that do interest only. There'll be lenders that depending on how you buy the property, can roll off any costs at the end of the period when you've bought it and refurbished it, for example. So there's all sorts of flexibility there. You can go for full repayment at the back end once you've, let's just say, buy a 3-bedroom house. You do what we do, Matt, which is make it into a 5 or 6 bed HMO, and then you refinance that property at a higher value to pull out most, if not sometimes all the money, but typically you're leaving some money in.
Yeah.
The money that you then got in that property and the amount you've borrowed on that remortgage might be interest only, it might be on a repayment mortgage, or it might be on somewhere in between, like a hybrid of those two extremes.
Okay.
So again, this is why it's such a complex area. It's great to have a professional to help you find the right product that suits you, because your goal might be different to mine. You might be happy to leave all your money in for 20 years, whereas I wouldn't be happy with that. And again, you can get products that match typically the criteria that you want to work to when buying HMO.
And I guess one other point, in particular with lending, I guess, is security as well, right? So as standard, there's going to be first charge, legal charge over the property against which you're borrowing money on. Do you encounter instances where you have to give any additional security, additional collateral or personal guarantees or anything like that?
Yeah, good question. So we always buy our houses in a company. So it's not me, Jamie Medill, an individual, but take out the mortgage. It's the company take out the mortgage to go and buy the property. So the directors of the company, again, typically in our experience, have got to give personal guarantees.
Okay.
I think that's pretty much the norm. Also, they want to find out where the money's come from. So if it's not your source of funding to pay for the deposit and all the refurb, they'll want to know where it's coming from and having a paper record of that. So as I mentioned, we'll come on to using other people's money in a minute, but I'm always using other people's money, borrowing money, for example, or buying with joint venture partners. And they want to see the proof of whatever the agreement is. If it's not your cash, they want to know what the agreement is that you've either borrowed money on what terms and how you're going to pay it back and what security you've given. So it's really important to be transparent up front on that basis too.
One last thing that just popped in my mind, if you're buying it in a company, in addition to personal guarantees of directors and the legal charge on the property, do you often have a debenture as well on the company, like a fixed and floating charge on the company, or is it just legal charge on the property and a personal guarantee?
No, we've never come across that. We've never been asked for that. So typically with us, it's the mortgage in the company, and as security as well as the first charge on that property, it's the personal guarantee. But I'm sure there are others that do ask for debentures too.
Well, look, is there anything you feel that we haven't covered off, particularly to like traditional bank or finance house lending?
Yeah, bridging loans, big thing. So some people are terrified of bridging loans. I was before I started doing them myself, because I didn't really know enough about them. But bridging loans can be a great way to help you finance the purchase and the refurbishment of the property before then remortgaging the property at a higher value from an HMO point of view. So a bridging loan literally is a short-term loan. It can be from 12 to 24 months. And the idea is you take out what you need for a period of time, you do the works with that money, and then you pay that back until you've got, and it's almost like the bridge between the gap of purchasing and then refinancing. So bridging loans can be really invaluable. The key to understand about bridging loans is I would strongly recommend you taking them out for longer than you need, because if you take them out for say 6 months and there's some delays in a refurbishment, for example, in one of your HMOs, let's just say the refurb might delay the whole process by a month or 2 months, you might have expensive penalty fees to pay for that bridge. So always take it out for longer. And then if you pay it back earlier, even better. The other thing I'd recommend also is that you be very careful about the financing and the costs of that. Some bridging loans charge entry and exit fees, which might add a number of thousands of pounds onto the cost of that finance, as well as the amount of money you're borrowing. And because it's short-term finance, the lending will typically be a slightly higher rate than a traditional mortgage, for example. So let me give you some examples. You might pay 0.8% or 1% or even 1.5% a month for the duration of that bridging loan. And that can add up. Especially if you've then got penalty fees if you run over time. I'll always take out a bridge as an example, Matt, for 12 months, but I know I'll typically only use it for 6 and I'll pay it back early.
Are there any early repayment charges, or is it just if you go over the time that you get charged penalty interest or penalty charge fees?
I've never used personally a bridge that penalised me for paying back early. All of them are much more open, or rather the contract is to pay them penalty fees if you go over the time.
Yeah.
So if you break the agreement, i.e. if you've got 12 months and you pay it back, 12 months and 1 day, you're going to get a fee to pay, a penalty fee. If you pay back early, then again, generally no issue. But again, check with your broker, they can find you out certain products.
Talk me through the steps that need to be in place. So they've seen a property, that's great, opportunity to convert into, 5 or 6 beds from 3 beds, offer's been accepted, contracts exchanged. What is the funding process?
Okay, so if the property's worth £100,000 or you've agreed to buy it for £100,000, and then you've used, for example, somebody else's money or yours to pay for the deposit of £25,000, in many cases, this is what we do. We have used historically a bridging loan from Shawbrook Bank on their bridge to let HMO product to fund the remaining 75%, or in this case, £75,000 to buy the house. So that's how we've done it. Right. And then the bridge is paid back once the development's happened. Then it goes on to a remortgage at a higher level. So let's just say all of a sudden the house is now worth £200,000. I'll then get a Shawbrook Bank 75% HMO commercial mortgage for 75% of the 250. Sorry, £200,000, and the new value and the new mortgage pays off the bridge. Relatively quick, relatively easy. I think it will come back to the market. That's my gut feel. And there'll be other lenders out there who do that sort of product either as well. Now you can get a bridge that's not linked to the refinancing. So it could be 2 different companies, but again, there could be additional costs there. It's really important to do your financial due diligence. It's really important to get your broker to find you the most suitable product for you, but also work out the cost of that finance over the time you're going to borrow it for, because again, it can be a lot of money.
The third option, right, is working with prospective investors or using other people's money. Share a little bit about your experience with working with other people's money and how all that came about after you purchased your first couple of buy-to-let.
So in terms of other people's money, you're absolutely right. I think, Matt, it's the biggest challenge that people find, which is, can they do it? Who's got money, and why would someone invest in them? This is a mindset issue. So we'll cover that in a minute. But in terms of what you can do to use other people's money, there's only 2 things you can do. It's really straightforward, and it's protected by the law and by the Financial Conduct Authority, the FCA. And this is how it works. There's 2 types of people you can work with. What the FCA classify as sophisticated investors, and as the FCA classify as unsophisticated investors. Unsophisticated basically means having got a financial track record or working in the industry in some way, shape or form, and they typically classify friends and family members and others who don't work in finance, for example, as an unsophisticated investor. So definitely worth checking out the FCA.org website so you can see what their definition is and you can read it in a bit more detail. So someone who the FCA classifies as an unsophisticated investor is someone you can only borrow money from. And when you borrow money from them, you need to have a contract to explain exactly who you're borrowing money from, what you're going to be doing with it, how long you're borrowing it for, what security you're giving if they want security, and when you're going to pay it back and how much you're going to pay them back at that period of time. So it's got to be protected, and there's certain things you must do according to the FCA. So that's those types of people. Unsophisticated people means you can only do a loan, you cannot do a joint venture. Now, a joint venture, in the same way that Alex and I started working together, and I know you've done some JVs, Matt, so I'll ask you about that in a minute. A joint venture is when you are, in effect, creating an entity or a business or an investment together, and you're swapping elements of value. The value might be money from one person and time and experience and track record or the team they've got around them in the other. And with Alex and I, we did a JV. So I put some cash in initially, bought a house, and then part of his JV with me was to use his build teams, his track record, his experience, etc., time and effort, and we then bought a house together. So you can only do a joint venture as classified by the Financial Conduct Authority to someone who's already what they call either a sophisticated investor or a high net worth individual. So again, I won't go into details. Check out the FCA.org website so you can find that out yourselves. So that's the distinction. So with a sophisticated investor or high net worth, you can also do a loan and you can do a joint venture. But with an unsophisticated investor, you can only do a loan and not a joint venture.
A couple of things. I know you've mentioned the FCA link. We also had a little bit of a conversation around investor compliance. We discussed in some detail, sophisticated, unsophisticated, and high net worth, and the sort of processes and questions and know your client stuff that you need to go through in order to identify who you can work with and who you can't, and what level you can work with them at. Other than obviously the regulatory aspect, do you think that there's anything that we might not have covered off which listeners would find useful, or additional bits of implementation that we can give them?
The only thing I'd add, Matt, is this is all about mindset.
Yeah.
If you think you can raise money or you think you can't, you're absolutely right. It's about mindset. Everybody can do this. Please don't think that just because you haven't got the money, or you don't want to invest your money in a property to buy and convert to an HMO, and you've just got your knowledge about how to do it, don't think that's not worth as much as someone with the cash but not the knowledge who can then invest in HMOs. Because you should definitely view your skills and your knowledge as on par with someone who's got the cash without the knowledge or the skills or the time to go and do it. Otherwise, they'd be doing it themselves and they wouldn't be having a conversation with you. So I think that's the only thing I really want to cover, which is value what you've got, what experience you've got. It might not be specifically on HMOs. It might be something from your corporate life, for example, or other transferable skills you can bring elsewhere. But you are an investable person. If you've got some knowledge, if you've got you've done training, for example, you literally know your area inside out, you know what the numbers are in terms of buying, what the potential upside could be if you buy property and then convert to an HMO. Those are all things which are going to be useful to somebody else who hasn't got that knowledge, that experience. So don't think you are lower down the pecking order against someone who's higher up perceived pecking order with cash. You're not. You're absolutely on a par, and you can do a great either investment or loan together to work with each other to benefit you both.
Someone who doesn't necessarily have the time to do the groundwork, right? So to get the education, to find the right areas, to find the properties, to do the viewing, to do the setup and manage the operations and all that kind of stuff. So you're absolutely right. I think, the mindset of looking at the situation as being on par with someone who just bringing in the resource, i.e. the cash, but isn't actually doing any of the operational element, the going out and the finding, because that's an investment in time, right? And that time has a value, which is at least equal to the money that's being invested. In the context of all the stuff that we've discussed, I know we've spoken at length in terms of, the finance options, obviously doing it yourself, or traditional lending, including crowdfunding and working with other people's money, and the mindset element that comes into that as well. Is there a little nugget, a direction that we haven't really spoken about, which you can just leave our listeners with before we go?
The first tip is money costs. So what's the cost of money you are borrowing? If it's not your own, what's it going to cost? And factor that into your due diligence and your analysis, because you've got to pay it back. So factor in the cost of that money, definitely, in anything you buy. Whether you're looking to fund your rent to HMO business, or you're looking to borrow money to fund your property to buy and convert to an HMO, you've got to pay it back. So factor the cost of that money in. Secondly, if you're working with other people's money, or you're borrowing money from elsewhere, whatever you do, protect that agreement in a contract and make sure you pay it back. Because here's the thing. If you either borrowed money from somebody else, or you've done a JV together and you're just testing each other out and you secure one deal, make sure that deal works. Because when it does, that person might want to invest more money with you or lend you the money again. And all of a sudden, you realize you might never, ever need to rely on bank finance, which is an amazing thing to be in. So do due diligence, work out the cost of that money, pay people back if you borrow money, and protect it in a contract so that everyone's happy.
Funding sorted, you're now ready to start your HMO property business. This 5-part mini-series of the HMO experience is a quick start guide to help you understand the basics of getting started with HMO properties as a side hustle. If you've missed any of the videos in the mini-series, make sure you check out this playlist right here. You'll also find a bunch of videos with a deeper dive on the different aspects of starting and growing your HMO property side hustle, from finding your goldmine area to setting your property up and managing tenants, which applies whether you're interested in buying property or managing them via rental arbitrage or rent to rent. You can also access all of the resources that will help you on your journey by clicking the link in the video description below. Thanks for watching. Please hit that subscribe button if you haven't done so already, and I'll see you in the next video.